Welcome to the Greenleaf podcast here. We have myself, Dave Codre, and Josh Friedenson. We are going over all sorts of operational stuff and how we look at the real estate market. And one of the frequent questions we get asked is, when are we going to start buying apartments?
It's been a little bit.
We've gotten asked the question a lot, but yes, it has been quite a while. I think 2019, really early 2019, was the last time we bought an apartment, and we've been buying mostly flex.
What the last apartment deals we bought were Rock Hill, and
which
we've already sold, and Heritage, which we also have already sold.
Yep.
So that was back in our OZ days.
Yeah, so I mean, even buying stuff 2018, 2019, there was good price appreciation. We would exit those opportunities.
Yes.
So the thing we're looking at when we think about apartments versus flex is really like, how do we compare them? So a common data point that we think about is 100 units in the apartment world. That's a normal size apartment building, or 100,000 square feet in the flex space. So you've got two very comparable numbers that you can work with there. And if you think about an apartment building, a lot of times if most of what we're buying, 2-bedroom units, you have about 1,000 square feet. Mm-hmm. So you have fairly comparable total square footages that we're seeing in the market right now.
Where really the distinction comes in is, they mentioned 2-bedroom units. You normally have 2 bathrooms as well. So now we're looking at 200 bathrooms and 100 kitchens. And
there's a lot more that's going into apartments than a flex. For sure.
On average, 6 people per unit, maybe 5 people per unit. So 500-600 people that live there that, have at least 2 to 3 cars per unit, with people coming in and out. So it's a lot of movement, a lot of activity on the property. Compared to a commercial space, which 100,000 square feet might have 10 tenants, maybe 12, with a handful of employees. Because commercial, specifically talking about the flex space, there's only about 20 to 30% office space. The rest is storage and warehouse. So of the 100,000 square feet, 30,000 square feet is used for office. And generally speaking, you have 4 people per 1,000? 4 spots per.
You just have a lot less people.
Right.
Yeah. When we think about cost of these assets too, most flex stuff we're buying right now, we're able to purchase for around a 7% cap rate, and we're paying about $100 a square foot. So a 100,000 square foot building, we're going to pay roughly $10 million for, and the net operating income we expect to see out of that is around $700,000. On the apartment side, 100 apartments, rates right now, and we're in the affordable apartment space, so this is not high-end Class A, and this is not at the very bottom. So we're seeing about $150,000 a unit as a cost, and that's trading around a 5% cap rate. So that's roughly a $15 million purchase. That's going to yield $750,000 in net operating income out of those 2 acquisitions. Now, on the apartment side, when we think about income that comes out of apartments, we're always trying to compare, how do these assets work together? How do we make sure we're making a good investment decision? So we're always looking at the types of assets. On the apartment side, things we like, you're not fully dependent on a few tenants. You have 100 tenants, so you have a little bit of diversity of revenue, and you have shorter term leases. So as market rates do go up, you can quickly adjust your rental rates to accommodate that. Now, on the commercial side, our leases are much more fixed.
Yeah, right? 3 to 5 years, and some even as long as 10 years. And the escalations every year are built in, and sometimes we're inheriting those on the purchase side that that they already have a 1 or 2% fixed escalation, right. Or other times we get to negotiate that, and right now in a higher inflationary period, we can negotiate a 4% rental escalation.
Yeah, and it's, you buy an apartment building and you could say, hey, these rents are below market, I'll just renew them in a couple months. Like, that doesn't work on the commercial side. Right. They have a 5-year lease. You've got a good amount of time before that lease can be renewed at a higher rate. So, however, commercial side, those rents, you know what you're getting for a longer period of time. Now, on the expense side, this is where you see a lot of different nuances of how these assets are managed. Apartments, if you've ever rented an apartment, you are responsible for nothing. So the landlord is doing 100% of the work. Anything goes wrong, landlord is fixing that at their cost. So that requires 2 things. One, that exposes you to a lot of cost inflation for materials, and anyone's been paying attention the past 3 years, things have gotten a lot more expensive. Mm-hmm. So every time when we're doing stuff in apartments, we're hit with higher and higher costs, and it's harder and harder to manage that maintenance from those costs. And also, about 100 apartments, how we operate, we need about 3 full-time people to make that happen. And that's leasing, management, and maintenance on that asset to maintain it properly. The commercial space is a little bit different, right? We don't need anywhere near as many people. We have about half of a full person on the maintenance side because most of the costs are handled by the tenant, right? So they are taking care of really anything that happens within their space. And that means we're responsible for a lot less.
Right, and it's really the design of the property has, each of the tenant space has their own power meter. They have their own water meter. They really have control of their whole unit in and out. And the design of the lease is a triple net lease, meaning that all expenses for the property are passed through the tenant. So there's someone incentivized to take care of, maintain the property along with you because the expenses are being passed along to them.
Yeah, so they have a lot more say in the maintenance, but also then we have a lot less exposure to that cost. So it helps us on the inflation side, and it helps us on the cost side on the commercial component. But the trade-off is apartments and the residential side can gain a lot more from the revenue side and adjust their rates quicker. So you got a little bit of pros and cons between the two types there. And ultimately, when you get down to the net operating income from these two things, you've got about a 7% yield in flex and a 5% yield in apartments. Now, when we talk about debt, debt has been an exciting topic over the past year, I guess really since February of 2022 when rates started going up and kind of changed the world everyone was living in from a debt being essentially free to not free.
Right.
On the commercial side, we're seeing roughly 60% loan to value, and we're seeing around a 7%, 6 to 7% interest rate. All these loans, too, on the commercial side have some level of personal guarantee to them because there is not the federal lender that the multifamily side has. Not as much, right? So Freddie and Fannie, they're the majority lender for apartments.
They guarantee, the federal government backs all the loans, and they're able to package them up and sell them to Wall Street with a guarantee from the federal government.
So those rates are lower then too. We're typically seeing around 5.5% in the multifamily space, and they can get up to 70% loan to value. If you want to push it higher and get up to those levels. So with both of those lending terms, and there's no recourse on the Freddie and Fannie thing, so that's a big bonus for sponsors is that they don't have to personally guarantee it. Right. So, but at the end of the day, when you consider those two debt factors, pretty much all of the cash flow from apartments is eaten up by debt. When you buy a deal like that, there's almost no net income that is left. And then on the commercial side, you have about 3 or 4% return that is left post debt payments. So you at least have some cash flow on the commercial side.
Right. A lot of that is tied to really just the positive or negative leverage to cap rate. So apartments are a negative cap rate to leverage, meaning that the cap rate is lower than what you can borrow money at. When on the flex side, we can still buy properties at a higher cap rate than what debt's costing us.
Yeah. So the last part that goes in here is Capex, and that's one where there's not always a lot of current information. You're kind of making estimates. We have our own estimates that we use. I'm sure other people in the market do as well, but we've been doing ours for quite a few years now. So we have come to the plan that on the apartment side, it costs us about $500 a unit a year in Capex. And that translates to about 50 cents a square foot for what's covered on that Capex. Whereas on the commercial side, we mentioned commercial has lower expenses, but the Capex is higher. So we're reserving $2.25 a square foot per year on the commercial side. That doesn't mean we actually spend it, though. That means we are reserving it. On the residential side, we're reserving that $500 as well. So whether we actually spend those sometimes is different, but that's what we know over the years it's going to average out to in our experience.
Right.
That includes everything from windows and roofs, HVAC systems,
carpet
on
appliances.
turnovers, all that stuff. And On the commercial side, why it's so much higher too is we're factoring in two other aspects. One is leasing commissions that we have to pay, which could be once every 10 years, right? And then build outs. Turnover on a commercial asset is way different than on a residential. You could go from one tenant to a completely different type of tenant. We've done some medical build outs for flex space recently, and those are way higher than if you're going to put in a tire store. It's like they're completely different. So you need to be able to plan for that, and you have a lot more reserves on the commercial side to handle what may or may not happen. So, but ultimately, when we think about like, okay, are we going to get back into apartments? Right now, in both of those scenarios, they don't generate enough returns as is to meet your investment thresholds that really anyone's going to be satisfied with. I mean, you've got to hit preferred return rates that are 7-8%. So coming in with apartments at maybe 0 to 1% or in flex at 3 or 4%, you're going to have to do some work to get to your goals.
Yeah, and Dave and I have always focused really on creating current cash flow and cash on cash returns, much more so than renovating and flipping the deal to the next guy. The apartment world works and has worked really the last 5 years that we've missed out on it. That if you were to buy it and continue to increase rents to turn the property over and the tenant base over, increase rents even more, and then sell it to the next guy, it works all day long. It just does not cash flow based on current purchase prices. So we're really focused on how do we buy assets that have some level of yield that we can improve, and then as we improve it, enjoy the cash flow as we hold it.
Yeah, precisely. So for us to get back into multifamily, we're going to have to be able to see some current yield that's coming out of these things.
Yep.
Right? So let's take a minute here. I want to go through just kind of the pros and the cons that we're seeing in apartments and commercial and kind of wrap up where we are with things. If we think about the pros in the apartment space, I mean, one, there's an endless demand for housing, it seems right now. Almost every market you think about, the news is talking about how there's not enough housing, and nationally we need 4 or 5 million new units to come online. So there's definitely demand from what's out there right now, right? And you also have the variability with rents. You can change market rents at pretty short notice. Inherently, you get to turn over apartments every month and reach market rent that month. So that's definitely some pros there. On the con side, you're coming at a much higher basis right now in the apartment space. It's very different than it was 10 years ago.
You're definitely exceeding the cost of construction. To buy a Class C property at $150,000 a unit, the construction costs are about $150,000 a unit as well. So it looks much less interesting to buy a property that's 50 years old versus build something for brand new.
And apartments are also, they're very people intensive. If anyone tells you it's easy to just buy an apartment, it's totally passive, that is not the case. They require constant effort and manpower that also knows what they're doing. Not just any manpower. You need quality people to make these assets perform well and provide a good home for a resident. On the commercial side, I mean, the pros there are that you have a tenant who's paying a significantly less portion of their revenue towards rent. So it's less of a big commitment for them. Apartments, you see people spending 30, 40% of the rent, 30, 40% of their revenue or income on rent. Whereas commercial side, we're seeing significantly less than that.
Yeah, generally speaking, on the commercial side, rent ends up being about 5 to 10% of their revenue. Yeah, on the apartment side, being 35, pushing 40% of the revenue. Our question is, without substantial wage growth, it's going to be difficult to continue to keep raising apartment rents.
We have some of our tenants that have less than 1% of their revenue is going to rent, so it's not a huge commitment to them. And they're a much bigger organization than an individual in most cases. So that's a positive on the commercial side. There are definitely challenges that come with it, though. I mean, it's slower to move. So if you're going to lease a new space to someone, they don't just move in overnight. You might have to do some pretty heavy build outs. So you have to have significantly higher reserves to make that work on the commercial side. So now we look at these combined. I mean, we're more bullish on the flex right now simply because we get that current revenue out of the door. We feel like we have a better credit tenant that is in place because they're spending less of their income on rent than a typical person in an apartment. And we do like that we're at a lower basis. We've always been kind of basis oriented of how do we make sure we have a low cost structure of our assets. So that's what we like about those three. I think for us to get back into multifamily, we're going to have to see some reversion to that, seeing a lower basis or seeing higher current cash flow. That, again, we're fine if we have to lift it up, but we got to see something out of the gates before we're really willing to dive back in to that market.
Right. And what we like, ultimately what we like to see is that the current market environment allows that to happen, not that we can buy it now and in 3 years we have the ability to do that.
Correct. Yeah, in commercial, we are buying assets and bringing it to current market. Correct. Whereas residential is very much like, hey, this could be the future market. You're going to move the line and you're going to get to here. And it's kind of hoping. We're just trying to take commercial, bring it to where it's currently at.
Right.
So that seems a lot less risky when we think about an investment thesis. I hope that was helpful. We're always looking to provide information on how we're making our investment decisions, and it's a unique comparison looking at the size of our apartment assets versus the size of our flex deals and how they stack up to one another. So, thanks for watching. For more tips on operating and investing in real estate, please check us out at greenleafmanagement.com or find us on YouTube and Spotify.